Today, one of the largest chip makers in the entire world just had like $200 billion wiped off its valuation.
Just poof,
Yep.
completely gone in a single trading session.
Right, gone. And yet somehow the Dow Jones just hit an all-time record high today.
It is wild.
It really is. So welcome to today's deep dive into the daily market briefing for July 1st, 2026. If you are listening to this right now, you are basically staring at a market with a severe split personality.
Yeah, we are looking at a truly historic divergence here. I mean,
Yeah.
for the last couple of years, the whole market narrative has just been dominated by this synchronized tech boom.
All right, like a rising tide lifting all boats.
Exactly. Everything with a microchip just floated upward together. But today, that correlation completely broke. The major indices are telling two totally different stories about where capital is moving.
And that is exactly our mission today. We're going to decode the split personality.
Yeah.
We really want to figure out why the market is, rotating away from its heavy dependence on mega cap tech stocks.
Which is a huge shift.
It is a massive shift. And more importantly, we want to look at what this means for your broader understanding of the economy. Because to understand why the Nasdaq took such a beating today, we actually have to look at the biggest individual mover of the day.
Right, the company that ironically had a fantastic run despite the rest of the index sliding.
Exactly. Meta surged 10% today.
Yeah, making it one of the most active stocks across the entire market.
Yeah.
And, that kind of single-day jump for a trillion-dollar company, that requires a fundamental shift in how investors view its business model.
So let's talk about that shift, because they announced a brand new cloud infrastructure business today.
They did. They are stepping in to actively monetize their excess AI computing power.
Which puts immediate, intense pressure on all those neocloud competitors, right? Like those specialized startups that just sprang up over the last year purely to rent out server space and GPUs.
Oh, absolutely.
Yeah.
But I think we really need to look at the margins here because that is the real story for investors.
Yeah, investors have been sweating over Meta's balance sheet for a while now because the cost of building these AI models is just astronomical. I mean, they have been pouring billions and billions into infrastructure.
Right. And that infrastructure spend has basically been the single biggest dark cloud hanging over their stock. Until today, those servers were just a pure cost center.
They were just burning cash.
Exactly. Meta was buying the power, the cooling, the hardware, all with this hope that eventually, the consumer-facing AI products would generate enough revenue to pay for it all.
But what they did today was totally flip that equation.
They took a sunk cost and turned it into a potential revenue engine. They are turning around and selling the compute capacity that they aren't actively using to train their own models.
Let me throw an analogy out there to map this out for you, because I think the mechanics of this pivot are just brilliant.
Go for it.
So imagine a company decides they need this state-of-the-art private factory to build their products. They spend, I don't know, $10 billion building it.
A massive investment, yeah.
Right. But once it is fully operational, they realize they only actually need to run their own assembly lines about 70% of the time.
So 30% is just dead weight.
Exactly. The rest of the time, those incredibly expensive conveyor belts are just sitting there idle. So they start renting out the idle line time to other companies. Meta basically just built an Airbnb for AI compute.
I love that. That analogy holds up perfectly when you look at the broader ecosystem, too. Because at the exact same time Meta is offering up this rental space, the companies looking to build AI applications are desperately searching for cheaper places to run them.
Right, which brings us to the comments today from the CEO of Palantir. I mean, he publicly bashed the token models being used by companies like OpenAI and Anthropic.
He really did not hold back.
No, he didn't. But let's break down the mechanics of why a CEO of that caliber is suddenly turning against the token model.
Well, in a token model, you pay for AI based on usage. So every prompt you send to the server, every single word the AI generates in response, it costs a tiny fraction of a cent.
It's basically like paying for a taxi by the mile.
Exactly. And for an individual user, just asking a chatbot to write a quick email, the cost is totally negligible.
Sure, it's just pennies.
But at an enterprise scale, where a company might be pinging that model millions of times a day to analyze data or run customer service or automate workflows, those token costs compound exponentially.
The meter is always running.
Right. And the enterprise taxi bill is just becoming financially unsustainable.
So companies are looking at these skyrocketing monthly bills from OpenAI, and they are realizing, We just can't afford to run our businesses this way long term.
which forces them to prioritize efficiency. So they are pivoting toward open weight models instead.
Right, open weight models.
Yeah. In this scenario, rather than paying by the mile, you are basically buying the car. You
Hmm.
download the underlying AI architecture, which, by the way, companies like Meta have open sourced. You tweak it for your specific business needs, and you run it on your own rented infrastructure.
Perhaps the very infrastructure Meta is now renting out.
Exactly. It is a complete shift from relying on a centralized pay-per-prompt API to just, renting the factory and running the model yourself.
Okay, so if software giants are suddenly squeezing every last drop of efficiency out of their existing AI compute, and enterprise companies are shifting to cheaper open weight models that require like way less constant pinging of centralized supercomputers,
Right.
what does that mean for the companies actually building the hardware?
Well, it creates a severe hardware hangover.
Yeah.
And that is exactly why the Nasdaq took such a brutal beating today. We're seeing a massive shakeout in semiconductors.
Yeah, the primary drag on the index was Micron, which dropped, what, 11% today?
Yep, down 11%.
I mean, that is a $200 billion wipeout in market capitalization for Micron alone.
Yeah.
200 billion, and CRWV was right there with them, down 12%.
It was a bloodbath for some of these names.
But wait, I want to challenge the narrative here for a second. Because if I'm an investor and I am looking at a $200 billion crater in one of the world's most vital chip makers, that looks exactly like a bubble bursting.
It certainly feels like it.
Right. The immediate instinct is to assume the AI hype cycle has peaked and to just panic sell the entire tech portfolio. Why shouldn't you look at this drop and call it a burst bubble?
Because the damage is highly selective.
Yeah.
I mean, if the AI bubble were truly bursting, if the market was deciding that artificial intelligence was just a fad and abandoning the hardware altogether,
Yeah.
every single semiconductor stock would be in free fall right now.
True, but they aren't.
No, look at the rest of the board. NVIDIA held its ground. And AMD, which is a direct competitor in the AI chip space, actually gained 8% today.
Wow.
Yeah, it was one of the top gainers alongside Meta.
Okay, so why is AMD up 8% while Micron loses $200 billion? Help me understand the mechanics of that divergence.
It really comes down to where those specific companies fit into the evolving AI pipeline. We are transitioning from the build everything phase to the deploy efficiently phase.
Oh, okay, that makes sense.
Yeah, during the initial frenzy, companies bought literally every high bandwidth memory chip they could find to train these massive monolithic models. But now the market is recognizing that the future relies on running specialized open weight models efficiently.
So investors are aggressively rotating their capital away from the companies they associate with that initial training frenzy.
Exactly. And they are placing their bets on hardware companies they believe will dominate this leaner, efficiency-focused era. The market isn't abandoning AI at all. It is just maturing its investment thesis in real time.
So the era of buy everything with a microchip and ask questions later is officially over. Investors want actual proof of sustainable economics now.
Completely.
Well, let's follow that thread of efficiency then, because it leads us directly away from the hardware and straight into the other massive expense on any corporate balance sheet: human labor.
Right, the human element. And the data we received today provides a really fascinating reality check on how this AI revolution is actually playing out inside corporate HR departments.
Because for the last 2 years, we have seen these huge waves of tech layoffs, right? And the justification from the C-suite has almost universally been that they are streamlining operations and finding, AI efficiencies.
Right, replacing people with algorithms.
Exactly.
Yep.
But today's briefing highlights a really sharp reversal. Employers who laid off workers citing artificial intelligence are already starting to regret it.
Yeah, we are witnessing the friction between a technology's theoretical capability and its practical, real-world application.
It's totally different in practice.
It is. Companies bought into the hype that a large language model could simply replace a knowledge worker. But what they're realizing is that while AI is incredibly good at generating content or parsing data, it is fundamentally incapable of taking liability.
That is the core insight right there. I mean, you don't just pay an employee to execute a task, you pay them to absorb risk.
Precisely. An AI lacks contextual judgment. It requires constant human oversight to ensure it doesn't just hallucinate a legally binding contract or accidentally offend a major client.
Which would be disastrous.
Exactly. The friction of trying to force an algorithm to do a complex job that requires human intuition and legal accountability It is often costing these companies way more in lost productivity and oversight than they ever saved in payroll.
So they fired the humans to appease Wall Street, and now they are quietly realizing those same humans were basically holding the structural integrity of the business together.
It is a harsh lesson.
It is. And this realization in the tech sector connects directly to the broader macroeconomic data we got today, which shows that the overall labor market is noticeably cooling down.
Yeah, the ADP private payrolls report came in today, showing an increase of only 98,000 jobs in June.
Which is a pretty significant miss compared to expectations.
It really is. And looking ahead to the broader non-farm payrolls, the Dow Jones consensus is projecting a gain of just 115,000.
So hiring is undeniably tapping the brakes across the board. But there is a crazy detail in today's briefing that introduces a total wild card into this data.
Oh, the World Cup anomaly.
Yes. Goldman Sachs released an estimate today stating that the upcoming World Cup could artificially boost the June jobs report by 40,000 jobs.
Which makes sense. I mean, you have this massive influx of temporary hiring, hospitality, security, logistics, tourism, all tied to a huge global sporting event happening right here in North America.
Right.
And that temporary surge is actually large enough to materially alter a national macroeconomic indicator.
But think about the implications of that for a second. The Federal Reserve uses these exact labor numbers to decide whether to raise or lower interest rates. Trillions of dollars move based on whether the market thinks the economy is running hot or cold.
It's the foundation of everything.
Right. So if these foundational data points are being visibly skewed by a soccer tournament, how can the market or the Fed accurately gauge the true underlying health of the economy?
It introduces a massive layer of statistical noise. Analysts trying to figure out if we are heading for a soft landing or a recession literally have to mentally subtract 40,000 temporary stadium vendors and hotel staff just to see the real economic trend line.
It's crazy.
It really makes you wonder how many other invisible variables are skewing the macro data on any given month, making it just incredibly difficult to navigate policy.
Well, while we're looking at the macro environment, let's touch on two other policy and inflation updates from the briefing that just add to this complex picture. First, traders on Kalshi, which is the prediction market where people bet real money on real-world outcomes, they currently believe that inflation officially peaked back in May.
Right, and that was driven largely by falling energy prices throughout June.
Exactly.
Which provides some essential breathing room for consumers at the pump, even as the overall cost of living just remains historically high.
Yeah, people are still feeling it. And on the policy front, the Trump administration's proposed limits on the student loan forgiveness program have officially been blocked by the courts.
So that adds another layer of uncertainty.
Right. So whether you are looking at gas prices, student debt, or a cooling job market heavily skewed by a sporting event, the everyday consumer is just navigating this maze of conflicting economic signals.
And all of those conflicting signals contribute to a pervasive sense of economic uncertainty. When the data is this noisy and the tech sector is undergoing such a volatile transition, institutional capital looks for a place to hide.
Which perfectly explains the other half of our split personality market today.
Exactly.
Because we spent the entire first half of this deep dive breaking down why the Nasdaq was bleeding out. But the Dow Jones hit absolute record highs today. If tech is correcting and the labor market is flashing warning signs, why is the Dow celebrating?
Well, because the Dow is historically weighted towards safety, reliability, and tangible assets. This economic uncertainty is driving a massive rotation into value and industrial sectors.
So they are pulling out of the risky stuff.
Yeah. Investors are taking the massive profits they made during the AI run-up, and they are moving that capital into companies that manufacture physical goods, companies that pay reliable dividends, and companies with highly predictable cash flows.
Right.
That flight to safety is exactly what pushed the Dow to its record highs.
It is the old guard outperforming the new kids on the block. But the industrial sector isn't totally immune to macro volatility either. Let's zoom in on a key sector within the Dow that is facing a monumental wave of uncertainty right now, the auto industry.
Oh, yeah. The briefing highlighted a very critical policy shift developing today. The U.S. formally announced it will not renew the USMCA trade deal.
That's the United States-Mexico-Canada agreement, which replaced NAFTA.
Right. And by allowing that deal to lapse without renewal, the U.S. is opening the door for incredibly tense, high-stakes renegotiations with its two biggest trading partners.
Now, trade policy can sound pretty dry on the surface, I know, but for the auto industry, this is an absolute earthquake. Let's get into the mechanics of why a lapsed trade deal basically paralyzes car manufacturers.
It all comes down to a mechanism called the rules of origin. Under any North American trade agreement, a specific percentage of a vehicle's components actually must be manufactured within the U.S., Canada, or Mexico to qualify for zero tariff movement across borders.
Meaning a manufacturer can't just source a bunch of cheap steel and batteries from overseas, assemble the car in a Mexican plant, and then sell it tariff-free to a buyer in Texas.
Exactly. The rules of origin dictate the architecture of the entire global supply chain. Under NAFTA, that threshold was one specific number. Under USMCA, it was raised higher to force more localized manufacturing.
Right.
By throwing the future of the USMCA into doubt, automakers suddenly have zero visibility into what the rules of origin will be in 3 or 4 years.
And you just can't build cars without a decade of forward planning. It's impossible.
You simply cannot make capital allocation decisions when the rules are totally blank.
Yeah.
I mean, do you authorize a $2 billion battery plant in Mexico today? Do you sign a 5-year contract for Canadian steel?
You don't know.
Right. If the tariff structures change in the middle of construction, those investments become completely toxic. The entire North American auto supply chain is effectively frozen in place until the trade policy is resolved.
Let's ground this macro-level trade policy into a reality check for you listening right now, because supply chain freezes ultimately roll downhill to the consumer lot.
They always do.
We are already in a situation where budget-conscious buyers are entirely priced out of the market. The briefing today pointed out a stark, honestly depressing reality. The $20,000 new vehicle is now effectively extinct in the United States.
It really is. The combination of persistent inflation, previous supply chain shocks, and just the mandate to pack modern cars full of expensive sensory technology, it has pushed the floor price of a new vehicle completely out of reach for a massive segment of the working population.
Right, consumers are desperately hunting for budget, entry-level commuter cars.
And the industry is simply not producing them.
And when you add trade war uncertainty on top of that existing shortage, it just creates a perfect storm against the consumer. I mean, if an automaker doesn't know what their cross-border supply chain is going to cost next year, they are certainly not going to take a risk on designing a low-margin budget vehicle.
Exactly. It forces them to protect their balance sheets by focusing almost exclusively on high-margin, luxury trucks and SUVs, which just further alienates the budget-conscious buyer who just needs a reliable way to get to work.
Well, let's take a step back and synthesize everything we have unpacked today, because we have covered incredible ground across the entire economy. From the very top, the defining theme of today's market action is a deep structural rotation.
Yes.
We are watching the market aggressively pull away from its blind reliance on mega-cap tech stocks and really pivot toward tangible value.
The overarching narrative has definitively shifted from growth at all costs to a very sobering, relentless focus on efficiency.
We started out talking about a rising tide that lifts all boats, but the reality of July 1st, 2026, is that the tide is getting much, much smarter about where it chooses to flow.
It is being highly selective.
We are in the middle of a widespread efficiency reckoning that touches every single corner of the economy. Just think about the through line we traced today. Software companies are hunting for cheaper, open-weight AI models because paying by the token is financially ruinous.
Right.
Meta is renting out its spare server compute because they can no longer afford to let expensive infrastructure sit idle. Employers who fired humans to appease the AI hype cycle are realizing that human workers are fundamentally vital for absorbing risk.
And everyday consumers are begging for budget cars that no longer exist, because global supply chains are too strained and uncertain to produce them.
Every single story we analyzed today, from the server farms of a trillion-dollar tech giant all the way down to the sticker price of a commuter car, is bound by that exact same principle.
The entire economy is being forced to figure out how to do more with less.
Which leaves me with a final provocative thought. I want you to mull over today as you look at your own portfolio or your own business. We have spent the last decade assuming that the biggest rewards always go to the disruptors.
The innovators.
Right? But as the market rotates away from hype and toward value, are we entering a new era? An era where the biggest winners aren't necessarily the companies inventing the next shiny new thing, but rather the companies figuring out how to perfectly optimize the resources we already have.
When capital gets expensive, the optimizers usually inherit the market.
It is a profound shift in how we value business. Thank you for joining us on today's deep dive into the briefing. Keep looking past the simple narratives, keep questioning the underlying mechanics of the headlines, and we'll catch you next time.